I'm Dr. P. Spoorthy, Assistant Professor, Department of MBA, MLR Institute of Technology, Hyderabad. I'm going to deal with financial reporting and analysis as part of this Unit 1 Introduction to Accounting. In this video, let us look into the overview of the subject, introduction, history of accounting, definition of accounting, objectives of accounting, importance of accounting, bookkeeping, as well as principles of accounting. So these are the topics what we are going to cover in this today's lecture. Coming to the introduction of accounting, accounting is actually the language of business. It is called as a language of business as it is going to communicate its financial information to the different stakeholders, as well as it records financial transactions of all the business, and it will even provide reliable information to owners, investors, creditors and government, as well as it will help in decision making and financial control. So coming to this, actually accounting is called as a language of business means it is going to communicate financial information to the users like owners, investors, creditors and the government, and it will help even the organization in better decision making. Coming to the people who are all reliable on this financial information are internal users, like company managers would like to know what is its financial information. So it will even help the internal users, and it will even help the external users like banks, investors, governmental agencies, financial analysts and the labor unions. Now, the financial information provided by the accountants will answer all these sort of questions. Now, let us have a look at all these questions. Is the company profitable? Now, as an investor, you would like to know whether the company is profitable or whether the company is having enough cash to meet payroll needs, how much debt that the company have, how does the company net income compare to its budget, what is the balance owed by customers, how the company consistently paid cash dividends, how much income does each division generate, should the company invest more money to expand. So these are the questions can be answered to the investors as the data is being supplied by the accountants. So this is how the coming to this introduction to accounting. Now let us look into the history of accounting. Accounting is as old as civilization. It is as old as civilization. It means that this particular accounting is not existing since many years onwards. So the earliest accounting were recorded over 7,000 years ago among the ruins of ancient Mesopotamia. And in India, Chanakya is a person wrote a manuscript similar to a financial management book during Mauryan Empire. Actually, the book written by this Chanakya is called as the Arthashastra, which contains how to maintain the books of accounts, and this will really help the sovereign state around 3rd century BC. Later, it began in the 15th century. An Italian monk, Luca Pasilio, he is regarded as the father of accounting, as he was the next person who has involved much in accounting origin. And he recreated the common accounting system, and he developed the double entry bookkeeping system or double entry accounting system, and he published a book about how to record the books of accounts using double entry system. So this is how we can know the history of accounting. Now let us look into the definition of accounting. Coming to the meaning of accounting. Accounting is a process. Process means it's a step-by-step procedure where we follow to get an output. Let us look into what is the process. It is a process of recording. First, we begin the process with the recording, then classifying and summarizing financial transactions. This is what is the different steps what we perform in the accounting process. It provides information which is helpful in making better decisions. This is actually what is the meaning of accounting. And now let us look into the American Institute of Certified Public Accountants has defined accounting as it is an art. It is actually called as an art because, as I said already, it is a process, right? So it requires some art to start the process with recording. We record all the business transactions and then we start with the classification. We will be classifying it into different ledger books, and again after that we will summarize it in a significant manner and in terms of money transactions and events which are in part of at least a financial characters and interpreting the results thereof. This is actually the definition given by AIC PA. Now let us, from the definition, we can come out with some key aspects as recording. We are recording all the business transactions in the journal entries. In the journal entries, we record all the financial transactions like any wages related information, salaries related information, raw material purchased information, all that transactions we are going to record in the journal entry. After we record this from the in the journal entry, we are going to post it into the ledger account. That is what the second process called as the classification. Now here in the ledger account, we will prepare cash ledger account, and we will prepare wages account. Like that, we will be preparing all the ledger accounts after we take it from the journal entries. Then we start with the summarizing. In the summarizing, actually, what are we doing? After we complete this journal entries and the ledger accounts, we go with the preparation of trial balance. We take all the debit balance and the credit balance and profit and loss account. P&L account means profit and loss account, and finally we'll prepare the balance sheet. So these are the things what we are summarizing out of all the business transactions. And the last one is interpretation. Interpretation means we will analyze and we'll come with a conclusion saying that company is in a good position, company's liquidity position is good, or otherwise the company is in a good profitability position. Like that, we will be analyzing all the financial transactions, and it will help the management in better decision making. This is actually what is the definition of accounting, and these are actually the key aspects from the accounting definition. Now let us look into the objectives of accounting. Generally, the objectives of accounting may differ from business to business, but we can come out with some general objectives of accounting. What are the main objectives of accounting? The basic first objective is systematic record of business transaction. We are recording all the money related transactions systematically so that we are avoiding all any omission of entry or any fraud. We can even minimize all this, so that is the reason we are keeping record of all the business transactions in a systematic or in a standard format. Then we can ascertain the results of the operations. As I said, right, we'll be entering all the business transactions in the journal entries from there to ledger account, and then we will be identifying whether the company is into the profit position or the loss position. Then ascertain the financial position of the business. We can even ascertain the balance sheet. We can know what are its assets, what are its liabilities, and we can even know the financial position of the organization. It will even portray the liquidity position. What is the meaning of liquidity position? Means it is a company's ability to meet the short-term obligation. Means the company should be able to meet its short-term any sort of payments. Then it will even protect the business properties. Company will be having some sort of properties like machinery, assets and all this. So they are going to protect this business properties, and it will facilitate rational decision making. As we are following a proper standardized procedure, we can even make the decisions in a perfect way. Then it will satisfy the requirements of the law. We are even fulfilling the obligations, or we are complying with the income tax rules and the Companies Act rules. So these are the objectives of accounting. Now let us look into the importance of accounting. Importance of accounting will deal with these many aspects. Coming to the first one, systematic records. We will record all the transactions in a systematic order, in a proper format. As I said, right, first we start with the journal entries, then we go with the ledger accounts. So like that, we are following a systematic way of recording the business transactions, and it helps in preparation of financial statements. We can easily prepare the financial statements once we are done with this trial balance. Then it will even helps in assessment of progress. We can even know the progress of the company from last year to present year. We can know what is the progress in terms of sales or in terms of customers reviews or the orders, and all this we can easily ascertain by recording all these transactions. It will even help the management in decision making. It will even satisfy legal requirements. As I said, that according to Income Tax Act, or there will be some sort of auditing, and we are supposed to prepare the books in a proper format. So we are satisfying even legal requirements as per Companies Act and as per Income Tax Act, and we are providing information to the interested groups. Interested groups are the people like, it can be the investors from the general public or the financial institutions or creditors, and all these people can easily look into this accounting information and can take up a decision. It will even help us in legal evidence, as we are recording transactions as per the format, right? So it will even, we can show this as a legal evidence in case of any sort of dispute settlements and computation of tax. Where as we are recording in systematic order, right, we can even easily compute the taxation. We can complete even the taxation rules and all. The settlement during the merger, in case if there is any merger with any other company, if they look into all this accounting information of the past years as well as the present year, it can easily record and we can easily settlement can be done during this accounting, with the help of this accounting. Now let us look into the what is bookkeeping. We start actually with the bookkeeping, and now in this slide we will try to find out the differences between bookkeeping and the accounting. So bookkeeping is a systematic recording of financial transactions in a chronological order. So in both the bookkeeping and in the accounting, we go with the recording. It is a base point of recording all the business transactions. Then it is a foundation of accounting. As I said, right, first the bookkeeping we do with the bookkeeping. From the bookkeeping, we take that bookkeeping information as a base and we go for further analysis with the help of this accounting. That is what is the main aspect or advantage with this accounting. It deals with the recording, classifying and organizing. Bookkeeping will deal only up to organizing. It will not go with any analysis and interpretation and all this. So, it deals only with the recording, classifying and organizing. Now, let us look into some differences between bookkeeping and accounting. First one, scope. As I said, right, we will only go with the recording of all the financial transactions. And in the accounting, not only recording, but we will be analyzing and we will be interpreting the financial information and we'll come out with some balance sheet and the profit and loss account. Stage. It is the first stage. It is the beginning stage or it is a base stage. After this only we go with this accounting. So that is what accounting will come under as the next stage or the further stage of bookkeeping. Then coming to the decision making. This particular bookkeeping information will not help in decision making, but from this accounting information it helps in better decision making. Looking into the next base point, it is skill needed. What are the skills needed to prepare this bookkeeping? It clerical work. If we know the clerical work, we can record all the bookkeeping aspects. But to prepare this accounts, we need to have some analytical as well as decision making skills. Coming to the output. Now, what is the output of bookkeeping is, we will come out with a journal, ledger and the trial balance. But from the accounting, we will come out with a profit and loss account. Means we can easily ascertain whether the company has attained profit or loss, or we can even know the balance sheet. So these are the differences between bookkeeping and accounting. Now let us look into the principles of accounting. These principles of accounting are been defined as per GAAP. We call it a generally accepted accounting principles. So these accounting principles have been divided into accounting concepts, accounting conventions. So we have around 10 accounting concepts and 4 accounting conventions. We follow this as a principle in recording all the business transactions and coming out with the financial statements. Now let us look into what is exactly the accounting principles. So accounting principles are the rules, guidelines and frameworks followed while recording, classifying, summarizing and reporting financial transactions of any business. And it acts as a foundation of accounting practices. It is a base point. Without knowing these accounting principles, we cannot record the transactions and we cannot ascertain the results appropriately. It will ensure financial reports that are reliable. We can trust it. We can rely on the provided information. We can compare from one companies to another companies or from one year to another year data, and understandable. It is very easy to understand when we look into this accounting output. So these particular principles are being based on GAAP in most of the countries, and right now we are going with this IFRS, which is internationally accepted rules and regulations for accounting. Now let us look into what are these accounting concepts. Accounting concepts are the basic assumptions. By taking this as a basic assumptions, we will be preparing the accounting records. Basic assumptions underlying the preparation of financial statements. To prepare a financial statement as in final output of accounting, we need to rely on some basic assumptions. So that is what these are universally accepted ideas that form the foundation of accounting. So as I said, right, there are 10 accounting concepts. Now let us look into the one by one each. First one, business entity concept. So we generally start with this as a first concept for preparing this financial statement. So business entity concept means here the business and owner are treated separately. Means we are going to record the business transactions and we will never go with the personal transactions. The business people are there, the owners, their records or their any particular transactions we are not going to record in the books of company's accounts. So that is what actually the meaning of business entity concept. So we are not going to combine both the accounts. We will record only the business related transactions only. So that is the reason it is called as business entity concept. Coming to the next one, going concern concept. So going concern concept is the second concept which is talking about as all the businesses would like to continue operating indefinitely. They want to go ongoing. They want to continue the business. So that is the reason the assets are going to be valued on cost basis only, but not on any liquidation value. Liquidation value means not at the wind up of value, but we are recording on whatever the cost at that particular cost only we are recording that asset amount. So that is the reason depreciation is applied instead of immediate disposal. So we will be charging this depreciation per year on this fixed assets. So with the intention that the business will continue existing for a long period of time. Now let us look into the next concept, money measurement concept. This is a third concept. Here we will record only the money transactions or only the financial transactions. Any transaction which can be measured in terms of money, that transaction we will record. Like for example, non-financial factors like employee skills. We cannot measure the employee skills in terms of money. So we will not record this non-financial transaction. Like leadership qualities, like this we will not ignore. We will ignore and we will record only the monetary transactions. It ensures uniform measurement in accounts. So as we are recording only the financial transactions, so we are following a uniform method. Now let us look into the cost concept. In the cost concept, we will be recording all the assets at historical cost. We will record at historical cost, but not shown on any current market value. And it provides reliability in reporting because we will be recording all the assets at its purchased price only, but not on the market price. So like that, we need to follow all these accounting concepts and then we go with the accounting recording. All assets and expenses are recorded at their original price or original purchase price only, but not on the market price. Let us look into the next one, accounting period concept. Accounting period concept, here as I said, right, we'll be preparing the accounting records or the reports as a balance sheet. All these balance sheets will be preparing yearly. So we will prepare the balance sheet yearly. So here we might go with a calendar year or a financial year, but we are going to measure in terms of some particular period of time. So profit and performance are measured regularly. It helps in timely reporting. So here we will be following 12 months period to record all the transactions. As I said, we might use a calendar year, that is from January 1st to 31st December, or we might go with a financial year as a April 1st to 31st March. So we have to follow any one particular fixed period as a accounting period, and we have to record the transactions. Now let us look into the dual aspect concept. Dual aspect concept means every transaction we have two aspects. One as a debit aspect and the credit aspect. So this is what we'll call it as a double entry system. For every transaction, we should treat it in two aspects as debit and the credit. For example, cash purchase of furniture means we purchase the furniture on cash basis. So what is happening? Furniture is coming inside and the cash is going outside. So we are debiting the furniture and we are crediting the cash. So for every transaction, there will be a twofold effect, that is debit and then credit aspect. So that is what we'll call it as a dual aspect concept. And the next one is accrual concept. Accrual concept is very important concept as it involves recognizing revenues when they are earned and expenses when they are incurred, regardless of when we are receiving or when we are paying for the services. So we will record whenever the transaction has been occurred, but not on the date of the money received. Then there is something, another aspect called as matching concept. In the matching concept, we are going to match two things here. One is we are matching the revenues and expenses of that particular period, so that we can ascertain whether what is our profit measurement, whether we are getting profit or loss. So we are matching the both revenues and with the expenses. Example, wages matched with the sale of produced goods. Like that, we are going with this matching concept. So we are matching both the revenues with the expenses. Let us look into the ninth accounting concept as realization concept. So here revenue will be recognized at the time goods are sold and services are realized or rendered. It will not associate with receipt or cash. It means that whenever the transaction is happening at that particular time only, we are going to record the transaction, but not at the time of receipt of the cash. So for example, if a trader sells goods worth of 50,000 on 28th March 2025 on a credit basis, but the revenue is recognized in March 2025, but the payment is received in April 2025. So though we are receiving the money in April 2025, but we'll be recording the transaction on 28th March 2025 in the books of accounts. That is what actually the realization concept. Now let us look into the objective evidence concept. Here we will go with something as a reliable information, unbiased information and free from the personal judgment. We should go with whatever we are recording the transaction, that should have some evidence, or otherwise we cannot, it will be something called as a biased information. So for that reason, we have to go with some verifiable documents as a supporting documents to provide as a evidence for any further disputes. For that reason, we have to go with an objective evidence concept. So these are the accounting concepts as a part of accounting principles. Now let us look into the accounting conventions. Accounting conventions are practices and customs that have become accepted by accountants over a period of time, so that it will help us to ensure uniformity, consistency and comparability. Means if you want to compare one year performance with the other year, we have to rely on this accounting concepts. Now let us look into the four main accounting conventions. The first one is convention of disclosure. All the material and all the money related transactions have to be disclosed fully in the financial statements. Otherwise, it will not give us the correct result. So we have to go with the convention of disclosure. So disclosing all the records of transactions, so that, like for example, if the company has any pending lawsuit, it must be disclosed in notes to accounts, even though the final outcome is uncertain. So whatever the transactions are there, we have to disclose. It means we need to be very much transparent, so that we can show it as a proof and we can show that as a uniformity is been followed here. Then convention of materiality. Here in this particular convention, we are recording only the important items that affect the decision making should be disclosed. So insignificant details like any unimportant deals should not be maybe ignored to avoid unnecessary clutter. So we have to record only the material facts. Immaterial facts should not be recorded. Let us look into the convention of consistency. In the convention of consistency, we have to follow a particular method for over a period of time. So for example, if we are calculating the depreciation under straight line method, so we have to use the straight line method for the coming years also, or otherwise we have to give a disclosure saying that we changed the method from straight line method to written down value method. Like that, we to minimize this sort of errors, it is better advised to go with this consistency as a convention. Last one is convention of conservatism. In this, anticipate no profits but provide for all possible losses. We need to record all the expenses and the losses as they are incurring, but we cannot. Revenue is recognized only when reasonably certain. We will record only when it is realized, but we will be recording only the losses and expenses as they have been happened. These are actually the accounting principles. Now let us summarize this particular session. Accounting through GAAP ensures transparency, uniformity and reliability. It provides a true and fair view of business. It helps investors, creditors and management in decision making. In the next lecture, we will discuss about double entry system, recording how to record business transactions, classification of accounts and accounting cycle. Thank you.